If you look at the short end of the U.S. yield curve, it's predicting over 9 rate hikes between now and year end of 2022. The bond market continues to be pretty much in control of the Fed's movements and guiding them. Bonds have been slugging along with their gradual rise, which has reversed. This is now the worst bond year in my career, which goes back 40 years. Bond funds that are down 12 and 13% that have the word core in their name. Quantitative easing, which is ending, perhaps with a vengeance, ending perhaps with a vengeance, with a vengeance, with a vengeance. One should not be surprised that the stock market has petered out because there's no more money printing and we're on a quantitative tightening path and raising short-term interest rates aggressively. One should not be surprised. This is a very poor year for a 60-40 portfolio, actually the worst in decades. Value is a much better investment than growth. Value is a much better investment than growth. So value is the way to go. The NASDAQ 100 will probably continue to be the worst performer. NASDAQ 100 is now in a bear market if you use that classical definition of a 20% top. And now Europe is outperforming, which is sort of surprising given how the war is right on the doorstep of Europe. But Europe has now somewhat convincingly begun to outperform year to date by over 400 basis points. The 10-year Treasury yields 22 basis points more than the 2-year. This is not a good sign for the economy, say, a year from now or 18 months from now. The curve inverts. It's a recessionary signal. It's a leading indicator. And it's really when the curve de-inverts from an inverted position, choose tens, that you should really be on recession watch, which is what's happening right now. Durable goods likely to slow down with the Fed looking at perhaps 9 rate hikes, with housing obviously much less affordable, with home prices up and mortgage rates up. Parts of the economy that are likely going to be weakening as we move into 2023. That's the year that I think most, if we put all this stuff together, that is most likely when the next recession comes. The CPI, the year-over-year headline, which is at 8.5%. My favorite inflation indicator are those that don't have so many adjustments and hedonics and stuff like you have in the CPI. I like using import-export prices. These are pretty much unadulterated. Year-over-year export prices, which are now running 18.8%. We consume ourselves some of the things that we export that are in this price series. So this shows just how high inflation is on an unadjusted basis. Import prices, and they're also highly elevated, up in the double digits. So inflation has obviously proved not to be transitory, and it's likely to come down absent another spike in oil and natural gas prices. So we'll still have very elevated inflation for the year 2022. It probably won't be as high as what we're experiencing right now at about 8.5%. From 1994 till about 2011, all 3 of these asset classes had the same total return. But we turned bullish on commodities with double line in the middle of 2020 in the Bloomberg Commodity Index. It went from a level of 60 to basically double that. So it's doubled over the past 2 years with virtually no correction. But commodity cycles are very long-lived and they can go on for many, many years. And commodities have clearly started to outperform risk assets like equities, global equities and US equities. And those cycles tend to last a long time. We talked about this in 2020, that it was a generational opportunity to sell stocks and buy commodities. GDP-Now from the Atlanta Fed came out today, revised down to only 0.4% for the current quarter. So that's my macro overview. I hope it's helpful. I tried to keep it very tight.